The Rezolve.ai PLC RZLV stock is currently trading at $4.59, showing a modest intraday gain of plus 3.38% as of 11:15 a.m. EDT. Now, the surface-level story here is a steady, quiet day for an AI commerce stock that's mostly known for its volatility. But the deeper truth is in the volume. We're seeing over 4 million shares trade hands before lunch, which is significant when you consider the stock's recent price compression. This isn't just organic upward drift. There's a definite accumulation happening beneath the calm surface, possibly sparked by the subtle shift in institutional sentiment we tracked earlier this month, something most retail investors seem to have missed while focusing on the stock's multi-week drop from its recent highs near $7. The prevailing market expectation for Rezolve, particularly among the general retail crowd on platforms like Reddit, smaller finance subreddits, and X, has been a mix of over-optimism based on the AI theme alone, tempered by a deep frustration with the seemingly non-stop price decline following their strong half-year report back in October. The common belief is that the stock is either being actively manipulated by short sellers, a narrative that always gains traction in high volatility names, or that the company's recent acquisitions, though strategically solid, are creating too much near-term dilution and cash burn to justify a higher valuation right now. You see this tension everywhere online. The Diamond Hands crowd points to the $500 million annual recurring revenue ARR target for 2026 and the impressive 95.8% gross margin from the last report, calling it fundamentally undervalued. Meanwhile, the more skeptical voices fixate on the sheer volatility, the cash flow negative operations, and the fact that an AI stock that delivered a 426% year-over-year revenue increase and beat analyst EBITDA estimates still can't hold a price above $5. This expectation-reality gap is what fuels the daily trading fire in RZLV. The reality we're seeing today, however, challenges both of those extremes. The move isn't a short squeeze burst, not with only a $0.15 change, but it is a clear institutional flow absorbing the recent selling pressure. We know an estate-related transfer of over 10 million shares to a new, long-hold institutional investor happened recently. That kind of high-volume transfer, intended to be a long-term position, is the financial equivalent of a quiet titan stepping into the market. It creates a solid floor for the stock, and the steady volume today suggests this new institutional interest, or others following their lead, are buying on the dips created by the retail panic and short-term traders. Looking at the institutional activity from Fintel data, we saw an increase in total institutional owners to 103, with a dramatic surge in average portfolio allocation to the stock, which suggests big players are indeed moving in, not out. This data directly contradicts the prevailing online retail narrative that the smart money is leaving. The reality is that the smart money is establishing positions, while the retail community is distracted by the day-to-day noise and the immediate downward trend from the $7 range. The high short interest, around 7.73% of the float, with a low days-to-cover ratio of just over 1, tells a story of short sellers who are comfortable but exposed. They're likely betting that the company's path to profitability by mid-2026 is too distant and that the market will punish the stock's cash flow for a few more quarters. However, the short borrow fee rates, while having backed off slightly from their recent highs, remain elevated, adding a subtle pressure to the short position. If the price does begin to climb aggressively, that high-volume institutional floor could suddenly become the launching pad for a squeeze that the short sellers, currently feeling overconfident with the stock below $5, did not properly account for. The off-exchange short volume ratio, still hovering around 32%, highlights the significant dark pool activity related to shorting, which is a key source of the frustration and manipulation talk in retail forums. They see the price drop on low lit exchange volume and feel the system is rigged. While the term manipulation is strong, the high dark pool short activity undeniably creates an artificial lid on the price during periods of selling, making upward movement that much harder to sustain. The underlying business, Rezolve.ai, is centered on providing proprietary AI-driven commerce solutions, essentially building the next generation of digital engagement for large retailers and brands. Their core platform, the Brain Suite, enables what they call agentic commerce, which is a fancy way of saying autonomous AI agents handle search, personalization, and checkout in real time. Think of it as a fully automated, intelligent shopping assistant and payments engine all rolled into one. Their company's recent acquisitions, SmartPay and Subsquid, for a combined minimal cash and stock consideration, were about adding crucial infrastructure. SmartPay provides the digital asset payment rails, and Subsquid provides the decentralized data backbone, positioning RZLV at the intersection of AI, commerce, and digital payments, a truly massive total addressable market. These are highly strategic moves aimed at a future where commerce is far more intelligent and integrated with decentralized data structures and stablecoin payments, most notably their partnership with Tether. This is what the institutional money sees, a clear if still early-stage blueprint for dominating a niche in a trillion-dollar industry. The H1 2025 revenue of $6.3 million might seem small for a $1.48 billion market capitalization, but the 426% growth rate and the raised guidance to a minimum of $150 million ARR exit for 2025 and $500 million ARR exit for 2026 provides the forward-looking visibility that growth investors require. The reported $230 million cash balance after the recent financing rounds also provides a significant buffer for continued growth and further strategic acquisitions, which is a major counterpoint to the cash burn worry. The social media chatter reflects a deep split. On one side, there's the genuine excitement about the BrainPowa large language model, LLM, which the company claims is competitive with models like GPT-4 and Claude, but with minimal hallucinations, a huge selling point for enterprise clients. The posts are full of screenshots or articles mentioning the Google and Microsoft partnerships, viewing them as validation of the technology's potential. The frustration, however, is palpable. There's a constant stream of commentary about the stock's stubborn inability to track the massive gains seen in other pure-play AI stocks, leading to accusations of media bias or a concerted effort to keep the share price low before the next major announcement. The retail crowd feels like they're holding a winning lottery ticket that the market refuses to cash. They're desperately waiting for the next catalyst that will force the price to reflect the $500 million ARR target, which analysts are starting to price in with average price targets around the $7.89 mark. The sentiment is emotionally charged, a mix of hopeful tenacity and weary disbelief, which is a very dangerous cocktail for volatility. We even see small bursts of panic selling on minor drops, quickly bought back up, demonstrating that the conviction is fragile and driven more by hopium than by a firm grasp of the underlying institutional support. For traders looking ahead, the next key catalyst will be the evolution of that institutional accumulation and any concrete update on the pace of enterprise customer conversion. The market is now priced for continued rapid execution toward that 2026 ARR goal, which means any hiccup in customer rollout or a delay in the path to profitability could lead to a sharp correction. On the upside, the first sign that the company is on track to hit its $150 million 2025 exit rate, perhaps an early announcement of a major new partnership or successful implementation with a Fortune 100 retailer, would be enough to trigger a massive upward re-rating, particularly if short sellers are caught off guard. The price of $4.59 currently reflects a deep discount on the company's forward-looking guidance, but the market is demanding proof that the execution can match the vision. The long-term outlook is one where Rezolve must successfully integrate its AI, data, and payment layers to truly establish the agentic commerce ecosystem and justify its valuation. The path is full of execution risk, but the reward, should they succeed, is exponential. The current tension is that the institutional accumulation suggests the sophisticated players believe in the execution, while the street price reflects the retail fear and short seller cynicism. Ultimately, the question isn't about the technology, it's about whether the sales team can close enterprise clients fast enough to make the numbers real. The institutional buying today suggests they are betting on yes. Comment below how many shares of Rezolve.ai RZLV you currently hold, or if you're waiting for the stock to dip below $4 before buying. The final message here is simple. The market expectation, shaped by short-term traders and frustrated retail investors, is that RZLV is a high-growth stock that's stalling out, maybe even doomed to a slow grind lower until it proves profitability. But the deeper reality, evidenced by the high-quality institutional interest and the confirmed accelerating growth trajectory with a $230 million cash safety net, is that the current price is a fleeting opportunity created by an emotional disconnect in the market. The stock has a fortified base of new long-term investors who are not going anywhere, and their presence makes the current sub-$5 price less a sign of failure and more a temporary vacuum created by the psychological selling of the crowd. The expectations of another drop are being quietly absorbed by the reality of major funds building positions, a dynamic that suggests the downward pressure is losing steam. When the stock breaks out again, it will be because the market is finally forced to acknowledge that 426% year-over-year revenue and a 95.8% gross margin are not the stats of a failing venture, but one successfully transitioning to scale. And the current price will look like a clear mispricing by the panicked short-term crowd. The setup is the classic scenario where fundamental execution is slowly, surely overriding crowd psychology.